We finally had a quite strong day for energy stocks. And this is, as far as I'm aware, the strongest day we've seen for energy stocks since the sell-off began. And hopefully, this is finally the reversal we're expecting to see. Energy stocks need to still, even after today, move roughly 20 to 30% or more to catch up to where they should be, just given the current paradigm's price per barrel of oil. For example, OIH, the oil services ETF, was at $245 a share the last time when it peaked, when oil was around $69 a share. Now it's 70 plus. It closed the day at 191. It closed Friday at 181. That implies there's some $55 move just to get to where it was previously. But at that time, we expected OIH to continue going to where it should be given the price per barrel at previous levels with regards to the barrel. So let's say there's a 20 or 30% move given the current paradigm. We hadn't seen 70-ish barrel for 2-3 years now. And we had been in a different energy environment with a more drill, baby, drill environment. That is no longer the case. So it remains to be seen where the correct level is. But the sell-off has been very well explained by the Delta wave. It began with the Delta wave, and it now appears to be ending with the Delta wave. This move, if we don't make a new low, a new local low, based on where we've been hitting, looks to be creating a very solid, I'm not a technicals guy, but a very solid inverse head and shoulders trading pattern. That would indicate we had seen peak selling, still had some sellers remaining. They all have been washed out, and quite a strong bull rally is to ensue. And this is not entirely a technical move. This is a move backed up by fundamentals. And not just fundamentals that had brought us $245 per barrel or per OIH share, but ones that have developed further beyond that. So as the sell-off occurred, and this was broad energy industry sell-off, find me an energy stock besides Tesla that didn't experience this, hit everyone. However, many stocks had, in that period of time, increased dividends, began share buybacks, or, like Schlumberger, said they experienced material improvements to cash flow and margins. All three of these things were occurring very regularly throughout the energy stock sector, and this is not something that you can see anywhere else in the market. However, this area of the market saw a 30% decline. So it's safe to assume that there's reasonable buying opportunity considering all that structural good news is occurring and the stocks totally sold off. So at these levels, despite today's rally, it's a good buy in my opinion. I expect moves like this to continue, and we've seen this happen multiple times throughout the last year and a half. And it seems like each and every time there is a boop, boop, boop with nice move up, and it is actually quite fast. It's actually quite fast. So we're going to see what happens. But I'm ready. Bring it on. We'll see what happens. I'm quite excited. As for the rest of the market, well, a lot of people like mega cap tech and like the technology names. I'm more skeptical on the technology names, and I have been, I guess, wrong, even though I haven't technically lost money because of this. Since about January, February, I had lightened my technology exposure quite substantially, particularly in January. In January, I basically sold a lot of stuff. That was a pretty near-term good move. I bought it back, but when I bought it back, I was much more particular about what I bought back. I was not buying, Amazon, Apple, Microsoft, Tesla. I haven't touched any of those names, and they've done very well. Okay, that's where I'm wrong. I bought back the tech that I like regardless of what happens with the price. That I like even if the price sells down. Amazon, Apple, I don't really know if I want to hold a company like that going sideways, if it goes sideways. And we've seen for the last year or so, Apple, yes, it started to break out. Amazon, it's still sideways. Those companies don't offer maybe they had the last 10 years, but over the next 2, 5, 10 years, don't offer as attractive a average annual rate of return as something like Editas, for example, one of the, in my opinion, the best structured CRISPR/genetic engineering company that can easily do a 30% plus average annual return, whereas Amazon, sure, yeah, we've gotten like 20%, whatever, maybe more than that, whatever, but it's so freaking big. I don't want that, and it's so expensive. You can argue it is value oriented right now just because they do make a whole lot of money, and we should expect them to continue to make a whole lot of money. But it's not for me. I'm willing to dip my toe into that value kind of play, but not at a 60 times multiple. I'm looking more for like a 6 to 10 times multiple, which is what these energy companies are. Energy Transfer around a 6 forward PE, Exxon around a 10 PE given last quarters. Same thing with Schlumberger. So these companies are just very well priced, earning tremendously, expecting earnings to improve, and they're being priced as if they're dying in a couple years, and they're not. They have dividends in addition to earning well, whatever. But I'm sticking with the trade. This is just the beginning, if you ask me. Yes, it's nice. Yes, it feels good. But I think we have to expect a 20 to 30% plus move if oil stays flat. But a lot of people expect it to get to $80 to $100 a barrel. So that means quite a strong move from there. So we'll see what happens. And until next time, peace out.